Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia, and that is managed by our company LifeChamp. Our webinar today is titled How to Detect Financial Warnings in Companies. Welcome, everybody. My name is Shane Chu. I'm the moderator for this session. And today, we're going to talk about how to detect financial warnings in companies. Now, from time to time, there are companies whose share price crash in a matter of a few days, and wiping out billions of dollars from the stock market. And it is very important for us, to learn how do we detect all these kind of financial warnings before it happens, so that we can preserve our capital and prevent equity ruin, right? Today, we're going to look into many ways on how we can detect these kind of warnings in companies before it happens. We'll do our best to see what are the telltale signs that this is going to happen. And we've invited a very accomplished speaker to share with us, what are the telltale signs in these companies that are struggling. So before we begin, as usual, disclaimer, whatever we share in this session is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. If you decide to make any investment risk, you're 100% responsible for all your investment decisions. All right. So allow me to briefly introduce our speaker today. And he is the managing partner of MRR Consulting, dealing mainly with business appraisal, investment, and financial training. He's a chartered financial analyst, charter holder, chartered accountant of MIA, fellow of certified practicing accountant CPA Australia, certified fraud examiner, certified merger and acquisition advisor, international certified valuation specialist, and is also a registered member of the Business Valuers Association Malaysia and a member of Malaysian Institute of Accountants. Presently, he's a licensed investment advisor by the Securities Commission of Malaysia. He's Mr. Wei Hua. So, Mr. Wei, happy to have you here today to share with us about how do we detect early warnings in a company. All right. How are you today?
Hi, good. Thanks, Shane. Hi. Hi. Thank you, Shane. Hi, good evening to everyone. Today I will share with you on why does an audited financial account provide assurance, but it's actually not fraud proof. And then learn about the detecting all rated warnings, and then liquidities, management's related and strategy related warnings. Okay, so now start with first part. Okay, why in audited financial accounts sometimes actually we cannot rely fully, and what are the areas actually we need to be careful. Okay, now audits actually involve an independent evaluations of the company's financial records by an certified auditors. Okay, so the purpose actually to provide assurance that the financial statements are free from any material misstatement and are presented fairly in accordance with the accounting principles. However, so we need to understand some scope limitations. So all these are conducted on a test basis and then primarily on the identifying material misstatements, but not all inaccuracies. Okay, so you must understand that this actually the scope of limitations, and then inherent limitation will be audit do not function as an absolute guarantee that these are actually all fraud free. So sometimes they may have disagreement with the companies. Company may override of controls. Okay. Then next one will be reasonable assurance. So what your auditors actually provide is actually reasonable but not absolute assurance. Okay. So on the fairness of the financial statements and not guarantee of future viability of fraud detections. So basically, it means that overall, when you look at the financial statements, you need to be aware that what actually this company, when they actually produce this financial statement, so you need to make sure that the numbers can talk to you. So sometimes actually people say how to make the number talk to you. So is it make sense to you? All these numbers are. So some examples. Sometimes companies, very simple examples will be if a company sells 100 million sales, the sales levels, but if let's say the company values market cap into a few billions, then you need to ask whether it makes sense or not make sense with that kind of sales level, but can actually support the value companies in terms of billions. So it may have some exceptionals, but sometimes you may need to question whether the share price basically is actually supported by certain parties or not. Okay. Then sometimes you need to check through the numbers, whether a lot of times the noise behind the companies, sometimes actually the numbers are actually good, but in the end do have some problems. Okay. So that's why investors need to understand. We will go through some case studies later on. I'll show you the examples that you may be encountered. Okay, the numbers actually looks very good, but because actually high debts, in the end actually the company actually went bankrupt. Okay, so need to look through the numbers. Okay, so basically our role basically is to detect all these warnings. I'll explain to you shortly. Okay, now first one. What are the things resulting in a decline in the sales? So sometimes the physical volume actually drop, the prices for sales or services drop, then increase in actual sales returns. These are, in conclusion, it basically is if you see a company drop in sales, you need to get some warning ready. Okay, so sometimes why actually drop in sales? So sometimes because of their business actually going through if let's say it's overall industry actually facing downturns, then it's okay. Okay, but if let's say it's only specific to the companies, then you need to check through whether the drop in sales actually makes sense, not make sense. Okay, like examples over here. This is actually one company's XYZ. Okay, this is actually the we cannot mention company names. This is actually company XYZ. So if you look through the cumulative reports, if let's say the company sales is actually the latest fourth quarter is actually 14 million, but the loss is actually 18 million. So is it okay? So basically, the loss is actually more than the revenue. So to me, this is actually a big warning. If you look through the cumulative, the quarters that they have, so basically it's the recent quarter actually show a big drop. So to me, be careful already. Okay. But before they actually show the results, in fact, actually the share price plunged a lot. Okay, so be careful. Okay, so key point basically is the company actually drop in sales, actually not a good sign. Okay, especially the loss that they incur even more than the revenue. Then really you need to be aware. If possible, my view is actually if possible cut. Okay, cut the cut loss. Okay. Because I think tough already. Okay. I'm not saying that it cannot turn around, but to me, it's actually tough. Okay. Now, next one. the resulting is drop in actually gross margin. So what are things actually drop in margins? Sometimes actually expansions, then change of the product mix, decline in actually revenue due to the lower selling prices, excess capacities, declining revenues, volume, increase in costs associated with the general cost increase, forex, favorable for forex movement, sometimes lower gross margin of acquired companies. So that's why cause a decline in gross margin. Then what things actually drop, cause an increase in selling price, sellings and general and administrative expenses. Okay, expansions ahead of sales growth, decline in actual revenue due to lower volume, increase in admin costs. Okay, last time actually one companies, one listed companies, they always put a lot of monies in advertising. So in the end, if you ask me how the company, I think the company I think gone already. Okay, because they, even though they actually do have sales, but actually the cost, the expenses, the marketing expenses, they the income that they get, they cannot cover for the marketing costs. So that's why then in the end actually gone. Okay, so my view here basically is that you look through the numbers, actually they can sustain or not. Okay, because if you continue to incur losses, then someone need to come up money to support the growth. So, and furthermore, actually the company actually in the end, the whole industry actually quite competitive. So in the end, they're supposed to get the kind of sales. In the end, because of the high losses, then the whole company actually have problems. Then unfavorable foreign currency movement also can affect them. Now, next one will be resulting in the non-recurring charge against the income from the continuing operations. For example, all the write-downs, okay, impairments, write-down inventory, receivables, impairments of their assets. Okay, so basically, if you see all these write-downs normally happen during bad time, you will see a lot of write-downs, receivables, inventory, fixed assets, or impairments. So all this check through whether it's because of the general economic downturn. So tend to have this, okay, everyone also facing the same problem, or because of that particular companies. If let's say due to that particular companies, then you check through whether what will be the future prospect. If let's say it's a one-off, then maybe you want to wait for further confirmation of whether you call back, continue to want to cut loss. But if let's say is continue to have these impairments, then you need to seriously consider investing, whether still want to invest in that companies. So if, as I said, if let's say it's overall industry economy growth actually financial crisis or whatever, so normally you do have all these account receivable write down, impairment, all this. So all industry also having the same problems. But if let's say everyone okay except that company only, then you need to check through. Okay. Sometimes you do have these restructuring events, like workforce reductions, okay, or some non-recurring item as I mentioned earlier, terminations of contract, litigations, mergers, okay, all these terminations, okay, environment costs, all this. So these are all one-off things. So you need to check through, okay, whether you will appear in the next quarter's results or not, or it's just one-off only. That's why check through, okay. If there's just one-off only, and overall later on economy recover, then they also recover, then it's okay. So, but if let's say it's if later on continue to have the same problem, then you need to seriously consider your investment ready. Next one basically will be profitability related early warnings. A drop in sales or decline margins, then slump is actually in sales or leverage, capital intensive companies or with fixed assets. So ever larger percentage of EBITDA. EBITDA stands for earning before interest, tax, depreciation, and amortizations, coming from the non-recurring, non-sustainable, non-operating. So sometimes you see sometimes companies that do have the income come from other areas. So you need to check through. Okay. So sometimes they do have the other incomes. Basically, a lot of times we may not able to see these exceptional items clearly. So sometimes they hide under other income. So that's why you need to check through the incomes come from whether it's actually normal operations or due to the non-recurring. Non-recurring means not the normal business operations. Okay. So if let's say for operating sources, for example, disposal gains, all this. So sometimes they boost the profits, but their profit may not be sustainable in futures. Then sales of assets with gains make up of the greater and greater percentage of incomes. Now, profitability related warnings sometimes can be due to the order backlog decline in several consecutive periods, increase in fixed assets, okay, in anticipation of the increased revenues. So you see, glove industries. I remember the one interviews conducted. I think AEC interviewed me during the when the I think the peak periods. I think towards the year end already. When the glove stock, some glove stocks, hit all-time high. I says that if you see the industries, everyone expand at the same time, or expand the production at the same time. So you need to be worried already. Okay, because that industries like glove industries, if everyone expand the productions, a lot of times actually, the moment the decline in sales only, the will lead to losses already. That's why what happened to the glove today. Okay, and glove industry always have these type of patterns, always like that. Okay, not the first time. Each time then they have any virus outbreaks, so they always have that kind of everyone go crazy, and then everyone, the glove companies start to expand the productions. Then later on, with the sales decline, the virus outbreak may be over. Then you see the demand actually drop sharply. Then they start to show high losses already. Okay, so these are profitability warnings. Okay, when everyone expand the production at the same time, buy more machine, expand the productions, fixed assets, then it's actually a big problem already. So underestimating the amount of bad debts in the allowance accounts, then high inventory level over previous years. Okay, so check through, the inventory. When I say, company like certain companies that do have high inventory, okay, always have high inventory, okay, but you need to check through, okay. If let's say the inventory days are increasing, then maybe may show some problems already for the companies. That means they have problem to sell out the products already. But we need to check through whether it's actually it's like, for example, like one of the stainless steel fasteners companies listed in Bursa. When they actually when the steel prices actually drop to low levels, they increase the inventory. So when they increase the inventory, so sometimes you need to check through the inventory whether it's actually a raw material, work in progress, or finished goods. So if let's say the drop in actually the steel prices, steel prices, they tend to buy the raw materials higher volumes. So sometimes you thought actually because they cannot sell the stainless steel fastener, but you need to check through the annual reports. So if let's say it's a raw material and it's actually lower steel prices, then it's okay. Then when the steel prices are getting higher, then the cost actually cheap. So the profit margin will go up. This is what happened to one of the stainless steel fasteners companies. Okay, so you need to check through whether it's the finished goods or raw materials. Like for example, some companies, I think like I think Padini. Okay, so sometimes they actually you see the inventory go up. So then you may ask actually what happened to these companies. So you need to check through whether it's a raw material or it's actually it's a finished goods. So it's actually finished goods. Then you may ask why they actually inventory actually went up higher. So a lot of time may be due to their expansion to new outlets. Okay, so sometimes when people come to buy, you cannot look at the catalog, right? You need to touch on the actual clothes, all this. So that's why each time they expand to new outlets, more outlets, so you see the inventory actually will go up. Now, next one, build out in inventory. That's why check through whether it's due to the dynamic high tech. Okay, then it's actually high tech companies. Then it's actually may not be good size if let's say no build inventories. Contractors, buildings in cost over billings could signal a loss. Then deterioration of the gross margins as percentage of the sales. Okay. Sometimes actually signal poor job costing, unexpected increase in raw materials, and they cannot pass to the cost to the customers. Then they actually bad signs. Okay, so need to check through. Then our significant drop in actually gross margin usually indicate more competitive pressures or some other factors. Okay. Now, next one basically is look at the interim statements show decline in margin. A lot of time the margin actually drop, then need to check through what happened caused the margin drop. Okay. So you see the Tesla share price coming down, right? Because actually the cut in prices. So we cut in prices, then you see they still make profit, but actually making lower profits. So that's why you see the once actually the cut prices, profit margin down, the share price actually will come down. Account receivables aging begins to indicate more accounts over 90 days. Increase raw material, as I mentioned, cannot pass to the customers. Then decline margins, unable to reduce the operating expenses, okay, due to fixed costs. Next one, basically liquidity related early warnings. So liquidity problems because of the increase in the overdraft indication, constraint actually working capitals positions. This is actually referring to the liquidity problems. So build out in inventory, they need monies, then they're unable to get the line of credits. Okay, so sometimes they expand too fast. They cannot get banks to support them. So they have a liquidity problems. So rapid growth and related expansion activities. So sometimes expand too fast, then dividend or withdrawal in excess of earnings. Where the net worth actually is decline, leverage actually increase. Okay, sometimes company may borrow money to pay dividends. So sometimes actually happens. So combination of the increase the fixed assets plus the increase the inventory, okay, then resulting in negative cash flows. Then writing on of account payables. So the payable days indicate getting higher. So it shows that they may have problem to pay the suppliers. Okay. Then next one will be increase in the payable days with the shrinking inventory, build up in account receivables, sales terms change. Okay. Significant increase in 90 days of receivables. So when you look through, they increase the actually receivable days or inventory days. So sometimes actually with the declining in sales, actually problems already. Okay. Higher usage of line of credits. Okay. Higher than the normal borrowings. If borrowing increase, then frequent call from the other creditors, then actually bad signs already. Okay. Then payment always delay, late, then reduction in actually cash balance in the bank. When you see cash balance drop sharply, then check through what actually caused the balance, actually cash balance drop, or increased loan from the shareholders, or constant loan requests for working capitals. Through expenses continue to grow beyond what is actually supported by growth. Then inability in the cash flow from operation to cover their long-term debts and interest expense. So now I'll share with you one examples here. Okay, so what do you think? This company is okay, not okay? Company A. Okay, so this company A, okay, so they shows actually jump in revenue, jump in revenues, profit actually went up. Then it's in fact the EBITDA margin increased, okay, gross margin maintained, net margin actually drop a bit, the EBITDA margin actually increased. Okay, so you see the profit actually grow, jump by 24%. So okay, not this company A. So we should not mention the name, okay. Then if you look through further, this company is actually in oil and gas. Okay, so then the total asset actually also increased. Okay, at the same time, actually the borrowing also increased. So when you look at these numbers, actually, is it cause any warning to you? Okay, then you look at the cash flow problems. Okay, you look at the cash flow problems. Okay, the operating cash flow actually increased. Okay, but the investing cash flow actually, continue higher. So if you understand free cash flows, free cash flow basically is these two numbers add up together. This consecutively 2 years is actually negative, and that's why they don't have enough cash flows, so they need to borrow from the bank. That's why the bank borrowing actually increased, jump very high. Okay, so is it good or bad? So this is actually liquidity problems for the companies. Okay, so my view here basically is this company expand quite fast. Okay, the profit shows yes, but the key problem basically is that they expand too fast, and then they buy fixed assets, and then they bought with the borrow monies, and they actually the borrowing getting higher and higher. Okay, and the from the earlier on 2018 is actually if you look at the borrowing divided by their equities point profit 0.5, later on jump more than one time. So basically these are, you need to check through whether the company able to support with that kind of high debts, especially oil and gas industry. Okay, so what happened to this company A? Oh, this company A, okay, the latest developments basically is that if you look through the company A, so from 2021, the sales last time 1 billion plus dropped all the way to the 2022 fourth quarter drop to 170 million, and you see the losses actually incur. Okay, basically this company gone already. So this company actually gone. Okay, so the key part basically is that, but the number I showed to you just now is actually 2018 numbers. So the key point basically is that when you see the company actually grow and the free cash flow is negative, free cash flow basically means that you take these two numbers, add up together in the cash flow statements, the net cash flow in operating plus the investing cash flow. So in this case, they actually free cash flow is negative about 600 million. So for 2018 and the free cash flow roughly about negative about 800 billion. So they're actually negative. That's why they don't have cash flow. That's why they need to borrow from the bank. So when they borrow from the bank, problem already. And then with the key part, especially 2019, they actually jump to very high levels. Okay. Then to me, higher than the equities, then you need to seriously be careful already. Even though they shows growth in sales, fantastic, everything fantastic. Okay. In the end, the holding gone. Okay. My point basically is that banks, okay, if the moment you borrow to many banks, okay, the moment one bank say want to ask you to pay back, or one bank cut the line, then all bank will do the same. Okay, that's why it's quite dangerous from our as an investor perspective. When you invest in high debt company, always be careful, because when any company actually borrow beyond many banks already, so normal time is okay, but the moment one bank start to cut financings only, and everyone will do the same, so ask you to pay back all the loans, then the holding gone already. So sometimes, so when you want to invest in those high debt company, you need to always understand, okay, the risk involved. If the moment one bank cut their financings or to the companies, then the rest of the bank will all panic, all will do the same. Okay, so that's why quite dangerous. Okay. Now, next one basically talk about the management related warnings. This one is actually delay in any management changes often too late to by the time they actually announce, okay, new managements or ownerships, unexpected change in management turnover, or key personnel actually resign. So check through whether the key person actually okay, not okay. So always at the moment the key owner actually resigns, then you need to check through whether okay or not they respected, or they have any backgrounds. Okay, so analysts had any view or not with this new managements. Okay, so the moment everyone actually resigns, for example, the company A, so what happened to the companies? you look at the board of directors, initially, wow, quite reputable. In the end, when they have problems, all directors actually resigns. So that's why when you see all this happens, you know, tough already. So when all of them actually resigns, so really tough already. Okay. So that means something wrong somewhere in the company already. Okay. And everyone want to be apart, attached to this company anymore. Next one will be the aging management or lack of management successions. Okay, sudden change in the duties of the CFO, also management warning. Then sometimes when you see management talk about the projections of the sales and earnings, sometimes far beyond past history. Okay. Now, people ask me, my client asked me, how to predict the market movement. I say it's very difficult, especially during these periods, especially in US, you have a lot of key companies announce their results. Okay, for example, the Meta actually announced good result, but the share price dropped because the CEO say they want to venture into the AI. The share price drops. Whereas Tesla reported bad results, but because they actually want to do some, I think the autonomous driving, all this, then the share price jump. Okay, so that's why sometimes you need to check through all this, because it's quite difficult to know what are the things actually, the share price up and down sometimes actually not caused by the result they actually announce. It's actually what they intend to do. So sometimes all this investor may not have confidence. For example, Meta investor actually may not have confidence with all these new ventures, because last time, if you remember, Meta venture into the metaverse. So what happened to the metaverse? So when they venture into metaverse, in the end, actually, the losses incur. So nothing until today, nothing happened already. So that's why sometimes investors are worried. The moment you start to talk about certain projections, okay, then inadequate forecasting of the capital requirements, okay, failure to meet the projections, then not prepared to any projections as to what future earnings would be, okay, then or customers uses the working capital loans to purchase fixed assets, okay, then owners actually frequently not around, okay, then excessive perks, then lifestyles not consistent with the profitability of the companies, then or divorce of the other family problems, okay. So if let's say the owner actually always not around, then problems, okay. Then lifestyle not consistent with the profit of the companies, also problems. Then lack of the complacent business management styles. So sometimes we do have listed companies, they're happy with what they have, but you see the company actually the result okay, but actually the key members are already aging. Already, but they don't have successions, and then sometimes they're happy with what they have, but the business actually stables. As a result, you look at the share price also stables. So that's why and no interest in the companies. Okay, so sometimes when you buy into this company, sometimes you see the price actually declining, over years declining in a small percentage every few months. So in the end, if you're long term, you notice that actually drop a lot. Okay, so because the people cannot see any growth. Then beside this will be like sometimes management warning is due to the growth that strikes the ability of the companies. So a lot of time people the listed company actually owners actually not aware that their skill actually do have expiry dates. So they have skill to run the small business into relatively big companies, but they may not have the skill to make it big. Okay, for example, they may have a skill to have 100 million run into 1 billion, but from 1 billion want to grow to 10 billion or 20 billion, but they may not have the skills. So that's why you need to check through whether they have skills, okay, to running big business. So that's why sometimes when the business actually grow up to the certain size, they need to engage outsiders to actually to grow the companies. Okay. Then next one basically is overpaying for when they talk about the rapid growth, and then without proper knowledge to handle it. Okay. then overpaying for acquisition, poor housekeeping, or lack of interaction between the management and laborers. Okay, so sometimes they want to talk about the growth, but may not have the knowledge on how to handle it. So that's why these are all warnings. Okay, change of the attitude, behavior, no backup management. So sometimes you see some companies actually expand too fast. I know last time actually one listed companies they actually expand quite fast, and then a lot of times when they expand quite fast, and a lot of times they their employees they mentioned to me that the owner actually really expand the business. But the key issue here is when the owner actually expand quite fast, okay, and expand too fast, the back rooms, risk management may not catch up to the growth. Then later on may have problems. Okay. Then sometimes the management do not understand the cost of growth, okay, inherent sales mentalities, then not keeping up with the technology, inflexible, of the senior management, coupled with the weak board directors, okay, litigations. When you see nowadays, you see the quarterly results at the backs actually do have a lot of litigations. Right? The moment you see a lot of litigations, many pages of litigations, it means that the owners actually have no time to look at the business ready. Every day they just spend time on talk, whether to sue people or being sued by people. So that's why they will spend a lot of time with the lawyers only. They don't have time on operations ready. So that's why check through. Okay. So always check through. Okay. When at the backs have many pages of litigation, the owner have no time to talk about the growth of companies already. Most of time, almost every day, they sit down with the lawyers only to sue people or being sued by people. Then fraud, tax fraud or evasion. Then next one basically is the external environment rated warnings. So look at the often actually best indicator earning declines outside the companies. Okay, so suddenly interest rates change of interest rates may affect the industry. Okay, so sometimes external things actually may happen, change in economic situations. Okay, you ask me this year, to me this year second half will be continue to be tough. Okay, I will say will be tough. Okay, Malaysia should be okay, but I think US, you see the growth actually coming down already. Okay, that's the reason why sometimes some economic reports have to say that we are scared of stagflation. Okay, mean to say high inflation but slower economic growth. So some signs showing that slow down. So whether will cause slow down worldwide. That's why yet to be seen. And then key part basically is that the whole thing is actually, the if less the chances of Trump coming back is actually is there. So the risk actually may be higher. So that's why these are the things actually affecting worldwide economies. And everyone start to position themselves. If let's say what happened is actually change to Trump actually coming back, then they impose tariff on China product 100% increase. Then what will happen to the rest of the world? All this change in economic situations, uh, environments, interest rate environments, and Trump is actually one lower interest rates and weak US dollars. Okay, so that's why things change. So need to look into the changes in economic conditions. Next one will be change in actually technology. We have AI right now, may affect some industry, have a tough time to survive. Then change technologies, then cost of productions, efficiencies, then industry downturns. Okay, so you can see, the soybean price come down, CPO price is also coming down. So what if let's say, the Trump come back, that will end the Ukraine and Russia conflicts, then the whole things, the price may go down further, Okay, so that's why it's actually things actually slowing down. Okay, then changes in actually industry slow down in actually in home building, fundamental change in the industry. That's for example the regulations in industry airlines. So sometimes actually due to fundamental change in the industries. Okay, AI actually caused some problems to some companies. So that's why may affect some companies because of the AI. Okay, Then borrowers operates in a declining competitive industry. Then regulatory considerations, their impact on operations, changes in competitions, market shares, or new competition come in, or overproductions, too many in the business, okay, changes in demand, okay. So all these sometimes new player come in, and then new competition, then overcapacities, okay, and everyone cutting prices. You see the EV cars in China's you ask me, all cutting prices. So of course Tesla will have tough times. Okay. So then it depends on how to survive. Okay. Then changes in demand for products and services. So next one is actually management's communications. So information flows slow. Okay. Then principal always not around to answer phone calls, lack of contact, lack of communications, not returning call. Then hard get in touch with the management. Then management don't want to answer questions. Okay. So they only talk about growth only, and then don't talk about other things. Okay, no knowledge about how about why negative trend are occurring. Okay. So sometimes you see reluctant to talk about the discuss of the trend, all this. So sometimes you need to look through. Okay. When you attend meetings, okay, see whether they hide anything or not. Okay. So check through. Okay. Sometimes you see certain listed company owners, they only talk about good part of the companies only. The rest on the negative things that they hide. Okay. Why? Because when you look through the annual reports, you already know the companies. What are actually key problems? But you notice that they always talk about good things only, but they avoid all the bad things. So that's why staff. Okay. Sometimes people ask me, how do we know these owners can be trusted, cannot be trusted? Last time I worked as analyst, part-time and full-time together, about 16 years. Okay. So what I can share with you is that how we analysts know whether this owner can be trusted, cannot be trusted. We look at their future prospect. So you look through the future prospect, what they say. So good one, for example, good one will be, they say that, very tough environment. So you will listen, you read through the quarterly report or annual report, you get worried. You say very tough operating situation. Then the next quarter result, hey, okay, the profit okay. Then you read through the future prospect again. They say, very tough operating operation. Then the following quarter, okay, good one always scared you with the quarterly results, but the result are okay, even better, But bad one will be they already incur high losses already. They say, well, we are optimistic of future performance, but you already know already when they announce results, they already know. You take 2 months report results, you already know your future prospect, good or bad. Yet they continue to tell lie and then to say, we are optimistic, but you see next following quarter, the loss even worse, even higher, lagi loss. So these type of companies, that's why to people like us, we look at this type of owner, cannot lah, this owner always tell lies. So my principle, my belief is actually, you can cheat some people all the time, all people some of the time, but not all people all the time. Okay, cannot. Okay, to me, it's actually you already know the annual reports where you have 4 months to prepare the annual reports. The most important part in annual reports will be the pages on that paragraph on future prospect. By the time you future prospect and you announce the annual reports, you in April, you already know, because a lot of time business already have a 3 month to 6 month orders. That means if by April you already know roughly until September to October situation already. You already know this company, okay, your company this year performance, okay, not okay. That's why your future performance should be quite close to the actual. So if you see not consistent, that means this owner, not honest. Not honest. That's how we know. That's why how we know the owners actually can be trusted or cannot be trusted. Okay. Sometimes people say, yeah, this owner cannot. So you talk about when a lot of times bad things that you're hiding. So they don't want to answer questions also. Then you know problem already. Okay. Comment from borrowers on problems. Then in discussion, customer focus on sales growth, but does not talk about the profitabilities. Then only talk about positive things, the some mention, all negative, all hide. Okay, in Hokkien we say siam. They all hide. So financial communication warning will be delay in financial statements. I mentioned to you, I work as analyst for 16 years, part-time, full-time together. So based on my 16-year experience, any company delay in the announcing the financial statement, normally bad one. Never come across good one. Never come across. The moment delay only, oh God, you see the moment delay only, a lot of times share price drop already. Second part, they quarrel with auditors, auditors or accountants, normally bad. So a lot of times you ask me, I call this as a cockroach theory. It means that you open up the cabinet, you see one cockroach, right? Then you close then you take the bygone spray, and then the cockroach die. Then you close the cabinet. The next time you open up, oh, two cockroaches. Then you say, never mind, I take the bygone and spray. Then you close the door again. Then the next day you open up, 4 cockroaches now. Why? Because at the back of the cabinet, all cockroaches. So when you see the delay only, this bad sign already. That's why a lot of time people say, so how? I say very easy only, cut loss. So you say, delay only, ma? Oh, delay. The moment they see the actual results, really bad one. So based on my experience, the company delay only, never turn out to be okay. Okay, never turn out. All bad one. Okay, and when they announce it, the share price will drop even further. Okay, so that's why when I explain delay, they quarrel with accountant, they quarrel with auditors, sue here, sue there, sue regulator, all this, all gone one. Okay, so to me, this one all gone. Okay, delay in fixing financial information, fix the problems, delay in getting financial statement promptly, all this gone. Okay, so take note of that. Okay, never turn out to be okay one. Okay, so delay in getting financial statements. Now, another thing basically is that, like, we are coming to the first quarter result already, right? Good one will tend to report the result earlier. Bad one will wait until the last day only. Good one will tend to be a few days earlier, so that the analysts have time to analyze the company. So if I say the result, they say, hey, normally they announce before the ending, because you have two months to prepare to announce the results. So it means to say first quarter end with 31st of March already. So they have until 31st of May to announce. So normally some companies, the good one, big one, they will announce 10 days before. So but this round, hey, why not announcing the result yet? You wait until the last day. Then last day only you sweat already lah. So normally they report earlier, right? They have to wait until the last day. Why wait until the last day? The key point basically is that because the last day, everyone announced the result together. Then analysts have no time to analyze it because we were analysts. Wow, so many, a few hundred companies within one day, how to analyze it. So analysts have no time to look at the companies. So then they hope to announce the results. Even analysts have look at the result, a lot of time the impact will be less already because analysts no time, because all announced at the same time, the last day. So that's why when you see delay only, you problem already. So good one, a lot of times, they suddenly report good result, right? They know very good result. They try to report early. Then analysts have time to analyze because normally right now, nobody announce the result. Then analysts will have only one counters only, so they have time to write, then to start write good things, then the time. So if I say bad, then you will wait until the last day. Okay, can? Borrower fail to provide financials in timely manners, failure to produce the interim result, as I said to you, the moment delay only, gone. Okay, change accountant, then management not particularly interested in timely reporting, delay here, delay there. So always remember, you be careful investing in these type of companies. Okay, change accountant, change auditors, change from reputable, non-reputable. So then frequent accounting principle change financial years. I come across last time I come across one company, I think 2 companies. Change financial year, 5 year change 6 times. think it's the Dato Kramat Holding and Georgetown Holding. I think not listed anymore. They changed until you cannot compare the financial results, the financial report, because some is 6 months, some is 9 months, some is 12 months, some is 15 months. Basically, that 5, 6 years, you look at the annual report, basically you cannot compare because they're not 12 month report. Some 12 months, some 6 months, some 9 months, some 15 months. Basically, you take out the report, actually you cannot compare. So like that. So a lot of time, they want to do this is actually the change financial. They change financial so that you cannot compare. You how to see this one 15 months or then unless you calculate and analyze it, divided by 15 times 12. Otherwise, how to compare? You cannot compare. So they make you a bit difficult. Okay. Then change in the financial format of income statement. Less details on cost of sales. Sometimes like that, they want to give details. Sometimes like that. Then providing only basic information only. Then you don't know what's actually why they actually perform badly. So lack of footnotes, disclosure, inability to obtain financial information. Then next one will be strategy related. Okay. Change the direction of the companies. Okay. New product line, new location, new vertical integration, change in business plan. So marketing, product line, management, fundamental change in the business, change from wholesales, okay, to retail. Then management change in the strategy commitments, okay. Market decline in the qualities and efficiency. Then change in the direction of the market. Or expansion at the time when there seems to be pullback, okay. So failure to recognize the change or failure to believe change in fundamentals. Expand to new markets, okay. Optimistic. A lot of times they actually expand to unrelated industry. My view here basically is that you notice that property prices getting higher, construction getting higher. The key always happen in Malaysia. Okay, the moment listed companies start to expand from the normal manufacturing, expand into property development, gone. 1998 or 1997, 1998, a lot of companies just because at that time of overheating, so you see a lot of companies gone have problems when they expand to these areas. Okay, so that's why always understand when they expand to the unrelated business or the area or industry, then the management have no skills. Be careful. Okay, you see the share price always down because people doubt they have skill to manage the kind of new business, especially like for example, certain manufacturing they do have a lot of piece of land, good locations. They start to venture into property development. So they don't have the skill, the knowledge, but suddenly, for manufacturing, they go into property developments. Problems. Because they cost them the attentions on this area, this new area where they don't have the skills. Okay. So it's a problem. And that means they may not have time on their existing business already. Okay. Then strategy related warnings will be unrated business, as I mentioned, take a lot of management time. Then unrated business or high risk expansions, or like for example, expansion of property sectors, okay, or non-related business segments. You see now, you don't see any regulatory parties to give warning on the properties prices, but you know that property prices actually in general start recovering already. Not yet. My view here basically, may continue to go out for a while. Okay, but if I say jump too high in the subsequent few years times, then the history just repeats itself. Okay, my view here basically is that history always, the current situation is like 201314. If you remember 231314, ringgit versus US dollars, it's actually at that time almost touching $3 now. If you remember. So why like that? Because when the US money and the hot money flow out to emerging markets, and at that time our property price actually jumped to high levels. Then Ben Negara gave warning. Then put warning on all these measure to cool down property. So you ask me whether we'll repeat or not. We are right now maybe at like 2010, 2011 that time. So the property price may will go up further. Okay, especially when the hot money start flow out from US. Last few years, actually money because of high interest rate all went to US dollars. Okay, but once actually US cut interest rate, this money may flow out to emerging markets. Some may come to Malaysia. So be careful on that. But it will not happen right now, later part, a few years later. Okay, so take note of strategy related, enter into non-related business, then management have no knowledge, okay, in those areas. Now, so I finished all my slides ready. Okay, now it's actually Q&A sessions. Okay, any question you want to ask me? All right.
Thank you so much, Mr. Uy, for doing a very enlightening session for us. How do you detect, early financial warnings of companies? So, I have a good laugh listening to your jokes along the way. But, that's such a very wonderful session, right? If you have any question to ask our speaker today, please write your questions in the Q&A box. We will address your question accordingly. All right. I think earlier on, I probably dropped off the line a bit during the introduction, so apologies for the technical glitch here. Now I'm back on. Okay, write your question in the Q&A box and not the chat box, okay? So the first question I see on my screen is that, can you elaborate further on the limitations of audited financial statements? Are there specific areas within the statements that are more susceptible to manipulation?
I would say nowadays, I will not say easily to manipulate the statements. Okay, I don't think it's that easy to manipulate the statement nowadays. Just that limitation means that you cannot say that the statements that you see is actually definitely same as the actuals. Okay, auditors, accountants actually try their best. Okay, so sometimes the specific areas actually will be something like how to say is actually like I would say you see one I can highlight to you is that nowadays we do have independent director as well. So to the extent the director is actually responsible for the financial statements. So nowadays the independent directors also quite careful, in signing off the reports. So they sit in the audit committees. So that's why a lot of times, sometimes you see these independent directors, they say, is it sure or not? Sure or not? So they try to make sure that they're comfortable with all these numbers. So that's why I need to highlight it. Because if let's say anything go wrong, so their liability, okay, like you have court cases, I think some actually, Transmile case actually, after 10 years only charge the directors, whoever's agree with the reports. So sometimes nowadays everyone quite careful, including all the independent directors, auditors as well, accountant as well. So my view here basically is that we can trust the financial statement, just that sometimes they still prepare, okay, as I say to you, according to the management view, okay. So we cannot, if you ask me any specific areas, hard to pinpoint. But my view here basically is that sometimes you see what the Transmile is actually the sales levels actually, it's not, they don't have the solid basis to support the sales. But to a normal investor, how do we know whether that sales actually real or not real? So key part basically is that you see the jump in sales, a lot of time the receivable also jump accordingly. So and then you see that basically is that they're not receiving money. It's basically jump in like happened to Transmile, is basically increased 300 million sales, 300 million receivable. At the same time, the revenue also increased by 300 million. So basically, it's like, they report actually sales. No, we don't know whether it's true or not true, because they're not receiving money. So that's why sometimes when but this one you can see from the cash flow statements. So that's why when each time they continue to have negative cash flows, So free cash flows, then you need to be warning ready. Okay. So that means you're not receiving the cash, the receivable jump to high levels, then you need to worry. Then in the end, I think they have problems actually, the auditors refuse to sign the reports. Nowadays, all this or immediately highlight to the Bursa already. So that's why I think in general, I think investors are protected in that manner. So we do have in auditors, accountants, and independent directors, doing their jobs. So try to minimize this part. So, but you cannot say, you still cannot say totally okay, the financial statements.
Thanks, Mr. Wing. I think just now you mentioned about independent director, the importance of having independent director. Can you comment on, the possibility of independent director uh, being actually non-independent? Could they be, the associates or friends of all these executive directors or the management? What do you think?
My view here basically is I think I'm not too sure the process wise. I think they have a pool or independent directors. I think need to get a point from the pool. Okay. Of course, they try to find someone that I think may be good to them. But basically, is that the independent directors need to be responsible for, if I say the financial statements, later on discover back got problems. Okay, any problems. So, and we're talking about these liabilities actually, carry with you for many years. So that's why they need to make sure that whatever they sign off the reports, make sure that it's actually okay. So that's why sometimes nowadays you look at board director trainings, especially independent board director trainings, they're talking about whether worth the risk or not with the director fee that we receive. So because high risk, high risk. Because sometimes we don't know. Then you say whether they are the independent directors, whether independent or not. To me, whether independent directors independent or not, I think they're from the pool. So I think should in general they are doing their best. Okay, I would not say definitely they're not independent. I would say they are doing their best because the liability is actually with them when they sign the
Thanks,
reports.
Mr. Wee.
Yeah.
Now just now you covered, four, more than four, I think
Yes,
also
yes.
got
Management
so you
communication,
can
yeah,
talk
financial
about
communication.
profitability, liquidity management, strategy related warnings. You also talk about communication, as a bonus and so on.
Yeah.
So would you be able to rank in terms of importance, which is the most important red flag among all these? Is it profitability or is it
The
communication?
key numbers just now, if you remember, I shared with you there's one company. The moment drop in sales is actually a bad sign. Okay, sales drop, then bad sign already. So for informations, I do browse through all the listed company results, all in Bursa. Okay, very simple. You go to the Bursa company announcements. Then you actually you sort based on financial results. So when the reporting season, I do sort based on the financial results. So all the results I actually browse through it. So the moment how I look at the result, okay, no, okay. The moment I see the sales drop, this company sales drop, don't need to look at them. So look at the sales drop, then losses, then forget it already. I will not look at them already. Wow, sales increase, profit increase. This one I will pay attention to them already. Then if I say, hey, quite good, no, the price actually quite cheap, then was sharp jump in prices, sales growth, profit also in jump in high levels. 20% jump, no, then I need to look at the results. So then I even read through the announcements. So if I say before market close, and especially big one, then normally buy beforehand before market close, because the next day analysts start to read the reports, then start to write the reports, then the share price will jump already, because you see the sales growth, profit growth, and the consistently growth. But this one apply to those big one blue chip shares, good one. Okay, so my point basically is that sales numbers are actually number one, and profit
I
levels.
see. Thanks for the highlight. The next question is, how can investors differentiate between temporary setbacks and signs of a more fundamental problem within the company?
So basically, is that if let's say the temporary setback will be, let's say for example, recessions. So we may happen this year. Okay, I will not say totally recession. It's actually a temporary setback. if economic growth slow down, okay, so technical recession also possible, okay, because US start to report no slower GDP already. So my point basically is that if overall industry, country economy slowing down, worldwide slowing down, then it's due to that reason, then it's okay. But if everyone doing well, suddenly that company actually not doing well, then need to be very quite careful, look through the whole things. So that's why I remember one bank. Every banks actually will take opportunity during financial crisis to write off, to clean out the loan portfolios. But everyone expect things to recover, economic recovery. Suddenly that banks start to report high losses, high provision, the loan loss. Ayo. So stressful. Why? Because we as analysts, how do we expect that these things can happen? So we don't expect this to happen. So if let's say everyone doing well, suddenly you are actually only one not doing well, then people start to worry, hey, is it due to your company, your management, the problems? Because normally everyone bad time, everyone will actually take the opportunity to clean out the loan and show high losses because everyone's also show high losses, what? Then take the opportunity to clean out everything. You show high losses, also okay. But when things recover, people don't expect to see it if you don't do it anymore. So that's why
Yep.
look at whether it's industry or country or just it's only your company specifically.
All right. Thanks for shedding light on this. The next question is sometimes there's a profit improvement as for per the earnings per share growth, but how come the net tangible asset will decline for that quarter? How can this happen? So this is one of the questions on
Oh,
my panel.
check through whether they pay out dividend or not. Okay, so you check through and then or high position, high what do you call it? They uh, the translation, uh, the trans not translation. They are the basically they are items that actually they uh, translate the write down on equity portion. That's why you can only see from the comprehensive the statements. So they may are items are not charged through the P&L, but actually look through from the what they call the write downs on the equity portions. So may affect the NTAs or they pay high dividends.
All right, thanks, Mr. Wing. Um, the next question is by Ahmad Amzar.
Yeah.
So when a company issues new shares for financial assistance such as ESOS, RI, etc., is it considered as warning signs for the company?
ESOS,
Right
ESOS,
issue, rights issue or
okay.
ESOS, right?
Okay, ESOS is okay. Okay, ESOS is okay because I mean, we can understand they want to have ESOS so that you need to perform this, then only can exercise all the ESOS. Otherwise, the ESOS becomes zero. Okay, so that means normally the exercise price actually should be higher. Okay, then they have staggered of that exercise price. It's okay. But for the right issues, investor want to have bonus issue, don't want to see the right issues. So because the moment you give dividend to us already, then after a few years, then you ask us to give you back the money that we get from you because you did call for right issues. So for those high capex companies, for example, airline business, so normally you notice that very hard, very hard. I mean, always call for right issues. Then you see sometimes they continue to put money and then the business continue not doing well. Okay, so investors sometimes the moment call for right issue, you see sometimes actually investors not happy with that. Okay.
All right, thanks, Mr. Wee, for your view. The next question is by Kennedy. So, what are your opinions on PN17 companies? Would you advise us to continue investing on them?
PN17 depends on what type of which ones. Okay, then to me, PN17 look at whether they have any some actually they continue to have a new business want to inject in discussions and then fail and then approval, all this. So some actually PN17 actually turned out to be okay. I think there's one of them actually come Comcord or something like that. I can't remember the name already. The share price jumped to high levels. So sometimes they're able to get out from the PN17 and with the new business, then you continue to grow. So in Malaysia, it's always like that. Okay. I'm not too sure the information right now. I mean the numbers right now. Last time I know is actually you invest a number of companies. A lot of times some may be good, some may have problems. Okay, so you need to check through. So some actually try is actually to write down. Then in Malaysia in general, if you're not careful with the companies, the certain companies, then how they turn around basically is that the new investor come in, they inject new business, then they change the company name. Then to certain investors, because you never pay attention to your stocks, right? So suddenly, hey, then you call a reminder, say, hey, what happened to my stocks? Then your reminder mentioned to, hey, change name already. My company changed name already. Then you try, hey, then you check, okay, no, okay. Well, I thought I have 10 lots. Why suddenly one lot only? Then because you write down, then share consolidation, then you change name. Sometimes actually like that. So to me, basically, is that first is look through what are business you inject in, what are new owners, and then any future plan. If don't have, then he think it's actually basically then you need to ask yourself whether still want to hold that companies or not, because sometimes you have no choice, then have to cut loss already. Series cannot means cannot. Okay, some cannot means cannot. Totally delisted one quite tough already.
All right. Thanks for a view on investing in PN17 companies. Now, talking about change of management and change of name, right? The following follow-up questions from Michael Wing is that, so he would like to know more about the change of management. Recently, there's one outsourced semiconductor assembly test company when the founder sold his stake to a new management, which is not an expert in this field. So what is your view on this?
So be careful. So is it cash out from by the owners? So if let's say cash out, then look through. That's why sometimes we don't know. Okay, the new management whether it's actually really have the skill. If you look through the profile don't have a skill, then be careful. So quite hard to say whether we really may have a certain experts or third party to run for them or whatever. We don't know. So the buyer, my view, he's always the because I'm a business valuer. So my view is always when the buyer buys certain things, they know what they're buying. Sellers, when they sell certain things, also know what they're selling. So they know what they're selling. So the buyer, if I say the amount is big, the buyers will know what they're buying. So the key part basically is that we need to look through whether the behind what actually the ultimate objective. Sometimes we may not know that's actually the main things. We need to find out from them. Okay, so but on paper, sometimes I agree that sometimes it appear that the buyer may not have the knowledge. Yes. So, but we don't know, seriously don't know the ultimate motive behind it. So sometimes we don't know. Okay. If the amount is big, then something you need to investigate further. I will not say that just because they don't have the knowledge, then it means no good. I will not say that. I will say need to look through, need to dig up further. That's why I always ask, why you want to buy the business? Then they will give you other information because of this. So sometimes this information may not be available to the public, so we don't know. Seriously, we don't know. So they may have certain things behind, we don't know. Then unless you have the chance to ask them, then they give you the information.
Thanks so much, Mr. Wing, for your view. Now, in an annual report, right, and also the quarterly report, the management often write about their comments on the future prospect, right? So, the question by Jason is, how reliable are these comments?
Okay, I give you one. I don't like the management say this. I don't like. I ask you, a lot of owners actually like to say is actually we are cautiously optimistic of or our future performance. I ask you, what is cautiously optimistic? Okay, I don't like these statements. Why? Because if let's say the result turned out to be bad, you say I cautious already, man. I already cautious you already, man. Cautious already, man. Then the result turned out to be good. I say cautiously optimistic, man. Optimistic, man. So basically, any management say cautiously optimistic as good as saying nothing, because they cover both sides. Are you cautious you already, man? So my view is actually, when you look at the future prospect, good one tend to be scared you, really scared you, but the result will be okay, consistently okay. But bad one will be they every year incur losses. Every year you look through the future prospect, they say we are optimistic of the company performance. We are bullish. How can you be bullish when you every year incur losses? Then you know that owners are telling lie, so you can write off this kind of owners. Next time, whatever he says, don't trust that whatever they say. So my view is basically is that this is actually a part where you check through. The best is actually look at 2-3 years annual reports, compare what they say and what is actual performance. If they continue to tell lie, then you know this company, the owner cannot be trusted.
All
You
right.
look through the past, a few years annual report, they always say what in the end what happened. So you take a 3 years annual report, good enough to know. If they continue to tell lie, then forget it. These are owners don't need. There's so many good company. Why don't you look at them?
All right, thanks for your view. I think unfortunately I always see this cautiously optimistic in the comment of future prospect. Have you seen any company that say I'm pessimistic?
Oh, got.
There are a few
Yeah,
cases.
Some
So they are
actually
very
really,
honest.
and you their result turned out to be bad. So, but not as bad as what they say lah. Sometimes really scared you, really scared. So I mean, do have some good, really tell you the truth. So they have very tough time. But sometimes actually the way they write, we really scared, no, really that bad. Then result, even though decline, but actually not really that bad lah. Sometimes they actually try to warn you lah. They're going to report bad results. So we do have this type of owners. I think quite good lah. Yeah, they tell the truth.
All right. Maybe I can draw attention to this qualified opinion by the accountants. Sometimes the auditor will have a qualified opinion. When this happen, right, what should we do?
As I said to you, these are the moment qualified opinion basically is that actually, like I said to you, there's some cockroach theory already. Basically, at the back so many cockroaches already. So my view is actually the moment qualified opinion only the back all cockroaches. So immediately is cut losses. Basically, going to have a lot of problems. We don't know what going to happen. So basically, it's like normal investors, you see this, then you ask yourself, what are the potential problems? So you see the normal smart investor will be immediately they just cut losses. They get off first, wait until the things clear. When I see the actual results, then okay. Then because I don't know, so I also don't know how big the holdings are. So to them, it's actually read through this, cut first. After all, if let's say it will drop further, and the big funds, especially good one, big fund need to offload, they also get scared, right? So they take times to sell down. No? Especially nowadays, we are talking about ESG. So ESG portion, we have the environment, social, and governance. So a lot of funds actually need to fulfill ESG. So especially certain funds, they do have because of ESG, investing guideline, all this. So the moment a certain company are unable to fulfill only, because these are corporate governance, so you see the sell down, heavy sell down. It will not drop, sell down one day, many days, weeks. So that's why to the smart investor is I cut loss first. If really good, then I'll buy back later. After all, I know that it will drop from now on for a few days, especially
All right.
good companies.
Thanks for the view. So the next question is by Mei Yue. What do you think of those PN17 companies that did not submit their regularization plan within the Bursa stipulated timeline?
Go with the delisted soon already. Cut losses.
All right. Thanks for a view. Having said about this delisted, right? So Kenny would like to ask this question: when a company got privatized and delisted, what rights do the shareholders have?
I think you're holding non-listed companies, then I think someone will contact you if, let's say, the company have a lot of assets. So to ask you, because if let's say drop to a few cents, for example, this company may have 20 cents NTA, but the share price dropped to 1 cent. So basically, they on purpose let it drop to 1 cent. So yes, you notice that someone buying 1 cent, 1 cent. So in the end, someone will call you, if let's say you own a lot of shares, they will call you. Then it says that you don't mind, I buy from you 2 cents. So it's a 10 cent, 20 cents NTA. Then basically then that collectors actually will buy from you. It's before closing it's 1 cent only. Then you buy from you 2 cents. You say 100% return already, as compared to the price that actually delisted. Then they accumulate from all the retails, then plus all the whatever shares they get cut from the banks or whatever, everything's. Then they actually sell off the assets and it's again make good returns. After all, they buy from you at 2 cents only, and then from the market 1 cent only. So they make, because the NTA is 20 cents, then they ask bank to write off the haircut, all this. In the end, then they sell out the assets. They still can get good returns. We have in the market, we do have people actually doing that. For those actually know how to invest into distress investing, they can get good returns, especially the value of the assets. So how to deal with the banks, all this. This one highly skilled areas. Not everyone, not anybody can know how to do the whole restructuring and offload all these assets and realize the returns.
All right. Thanks so much. Now, let's say a company is having a lot of material litigation. Do you think we should avoid this kind of company?
As I mentioned to you, this litigation, whether they sue people or being sued, the owner have no time on their business. Basically, they talk to the lawyer every day. So these are owners actually don't think of their any future prospect. Okay. Nothing there. Okay. So my view here basically is that like that. Okay, because I have value one company before. I looked through there were so many pages of litigation. So I also looked through the board director minutes. So basically, the whole board director minutes actually not talking about future prospect, talking about all litigation. The 2 hour plus every meetings only talk about litigation only. So I look at the minutes, basically talk about litigation only. Then why should I read through the litigation? I already know, because the quarterly result I already know the whatever. And I also, as a valuer, I don't need to know whether you win the case, lose the case. I only want to ask you is basically any further impairment or not. That's the most important questions. You tell me what any further impairment or not. That's the most important.
All right. Thanks, Mr. Wing. Now, the next question is by Hafiq. How about a spin-off company from the parents' company? And sometimes the reason they gave is that they say the company is want to be more focused in the selected field or expertise, right? So what is your opinion?
Okay, some spin-off was quite okay. I think the Sun W one actually quite okay. And then Hub Seng, the Mozet and Mozet spin-off okay. And then spin-off from some actually, I think the Sun W in general the spin-off quite okay. But you need to look through. Okay. So some spin-off you need to look through. So in general, like Hub Seng spin-off, Hub Seng Plantations, I think look down okay. So need to look through. Not every time spin-off okay. So you need to look through. Okay.
All right. Thanks for sharing your view. The next question, let's do this as last question from Mr. Yap, is that how about companies with high stock turnover rate? Is it normal for these kind of companies to have negative net operating cash flow?
High stock turnover means you're referring to the trading volume turnover, or you're talking about the inventory, the stock turnover. Okay, I believe you're talking about the trading volume stock turnover, right? So if let's say I just answer these two lah. So if let's say trading volume high turnover, so and everyday high turnover means someone is buying, someone is selling. So need to look through a lot of time. Someone have the inside information buying, someone have the inside information selling. So what the ultimate objective yet to be seen. Okay, wait for clearer signs. If let's say the price keep on inch up, that means the one buying one know what they're buying, so they don't mind paying higher price. So a lot of time maybe imply good news. That's actually for talking about trading volume. For those, if let's say it's a stocks, it's actually due to the inventory, then look through whether is it due to the unable to sell the inventory or not. So depends on, as I mentioned to you just now, Badinis and for example like Pokong the inventory. Basically Pokong the inventory day is the last time, I'm not too sure right now. Last time is I analyzed the counters actually is 270 days. Meaning to say when you buy jewelry from Pokong, it's actually the 9 months of holding periods. So that's why when they expand to the new outlets, you see the inventory go up. They continue to open outlets, then the inventory will go up. So then you don't worry, because the inventory gone up is because they expand to new outlets, same as Padini, all this. So that's why sometimes they need to look through the inventory essentially from that perspective. Okay, so depends on which one. Okay, I hope I answered your questions.
Yep. All right. Thanks, Mr. Wee, for doing this very engaging Q&A sessions. Of course, we still have many questions on the panel, which are not able to ask at the moment. So, but don't worry. If given any opportunity, we will bring back Mr. Wee for the next session with us. All right. Thanks, Mr. Wee, for your time. And before we go off, let me introduce to you to some tools that Bursa Malaysia have in store for you. If you go to bursamalaysia.com, you can actually explore this My Bursa. And if you click on My Bursa, it will take you to this portal, okay, which is My Bursa portal. Under My Bursa, there are a lot of knowledge and there are a lot of market information for you. Under this, there are also various tools you can explore. There are filters who can help you to filter and identify assets that meet your investment needs. And there are also heat map. Heat map is very common. Heat map give you a visual idea about what had happened to the stock market on that day. The one with a larger rectangle would means that they command a larger market cap. The one with more vivid color would mean that they have a greater volatility during that day. So you can check out heat map on My Bursa. And also Screener, they can help you to filter stock that meet your criteria. For instance, if you want to filter stocks that have, let me give me a minute. Let's go to a financial, they have a year-on-year growth in terms of profit. Okay, let's say 15% gain in terms of profit, revenue, and then 20% gain in terms of profit, or even analysts give a good rating. Okay, you can submit, and then it can help you to filter. Okay, or um, you can key in the analyst. Okay, I think it's under fundamental analyst recommendation. Let's say outperform or buy. These two rating, and then you want market cap that's more than say 1 billion. Okay, you type 1,000 million. Okay, then of course you can help you do screening. Okay, that meet your criteria. All right. So these are screeners that's provided by My Bursa. All right. So I hope we can take advantage of these tools that are provided by Bursa Malaysia. So for our next webinar is titled Maximum Keuntungan dengan Trading Plan Ya Betul, happening on the 6th of May 2024, 8:30 to 10 p.m. So if you want to register, you can click on the link that I've just given you in the chat box. And if you haven't checked out Bursa investment quiz yet, you may actually scan the QR code. This is an investment quiz that's open to Malaysian between the ages of 18 years old and 30 years old. So if you join this quiz, you'll stand a chance to win amazing prizes. Okay. So if you think that you have good investment knowledge, you can come and test yourself in this Bursa investment quiz. It is for Malaysian between the ages of 18 and 30 years old. All right. The champion will walk with 6,000 ringgit, followed by 4,000 ringgit for the first runner-up, 2,000 ringgit for the second runner-up, and 1,000 ringgit and 500 ringgit for the consolation prizes winners. All right. So it's happening on the 7th May, 14th May, and 21st of May. Okay, for the grand finale. So if you want to open a stock trading account, you may scan the QR code or click the link that's just given you. And that will be the end of this session. Thank you so much, Mr. Uy, for doing this session for us, which is how to detect financial warnings in the company. Hope that you gain enormous value learning from Mr. Uy today. So thank you so much, Mr. Uy, and hope you all have a great day. Bye-bye.
All right. Thank you.